133. Today is Thursday, November 26, 2020. Tax planning, property tax part 2. This is a 39.6 Facebook and YouTube live finance show so that teaches high earners like yourselves how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, paying for college, paying for childcare, and even the car you drive. Today's episode, we are going to continue talking about property tax, which we discussed a little bit yesterday or the other day in episode 132 in our series on year-end tax planning. If you can see me, you can hear me, please let me know. Shoot me a message in the chat. I'd appreciate it. All right, so we talked about a number of things the other day. As a refresher, here in Texas, at least where we are in DFW, property tax comes out in October, and you have until January 31st to pay for it without any penalties. So you can choose which year you pay for it, which is fantastic from a tax planning standpoint because it's a big bill, and you can choose which year you want to take the deduction, if it's a deduction. Okay. Remember, property tax is capped at $10,000. It's one of the state and local SALT taxes. It's one of the state and local taxes. If you live in a state with income tax, with a state income tax, a city income tax, this might not really be relevant to you because you may already hit $10,000 just on that alone. However, a lot of people relocate in the middle of the year without necessarily even planning on it. Okay, a lot of people are moving to the states like Florida and Texas that don't have state taxes because those are locations where the economies are growing more, much of which is probably related to their state income tax laws or lack of state income tax. So if you have a choice between paying property tax this year or next year, and you've already capped off the SALT limit of $10,000 based on your income tax, there's no reason to really pay for it now if you don't have to. Okay. Now, if you don't have a state income tax and you are planning to itemize for this year, then you could just pay for $10,000 and then leave the rest of it until January and pay the remainder then, because that way you're banking that extra deduction potential for next year. One of the things I don't think I brought up is the possibility that the tax laws could change and they could repeal the limit on SALT tax. So even though it's $10,000 this year, 5 years ago, there was no limit on how much state and local taxes that you could deduct. So, for example, our property tax bill is $16,000. We could pay $10,000 this year in December, carry $6,000 over, pay for that in January, and then next year pay the full $16,000, and then I get to keep $6,000 plus $16,000 and deduct $22,000 if they repeal the cap. Okay, so that's on the personal side. Now, if you have an Airbnb of your own personal residence, then part of your year is business use. Remember, there's no cap on how much deduction you can take on property tax when you're categorizing it as a business. So for example, if we rented out our house as an Airbnb for 6 months out of 12 months of the year, then half of my property tax would be on the business side and half of it would be on the personal side. So if we have a $16,000 property tax bill and we cut that in half, $8,000 of it would be on our personal return on Schedule A. And the other $8,000 would go on our Airbnb return on Schedule C. And in doing this, we would be able to deduct the full $16,000 from our income one way or the other because we're not getting basically thresholded at that $10,000 cap because part of it is business use and enough of it that the personal use is below $10,000. That $10,000 limit only applies to the personal portion of your property tax utilization. Okay, moving onward. So we have another rental property here in Texas. It's basically you have a duplex, and the other side has a big tax bill, it's $20,000. Okay, this is like the biggest bill we pay for anything all year round. And we can pay for it in December, we pay for it in January. And it's a long-term rental. We don't have full-time real estate professional status. And so it doesn't really help us from a tax perspective in terms of saving us money in tax this year. It just carries over in terms of losses. We have a bunch of losses on that property. Even if we didn't take that deduction in this year, 2020, and paid for it in 2021, we still have enough losses from depreciation that we've carried over from previous years that we would not be paying any tax on that property for this year. And we still have a bunch of other depreciation, passive losses on other assets that would offset it. So we don't have to pay for that property tax bill in December. We could wait till January. Now, one of the benefits of waiting until January is that next year, okay, so for example, our tenants are moving out, or at least their lease is expiring, I think, in May. So there's 7 more months of the year, and we may release it to another tenant or the same tenant, we don't know, or we may move to that side and then take advantage of the 2-year out of 5-year rule. If we live there for 2 years and then sell it, then all the capital gains would be tax-free. We have a lot of options. We could also convert it to, we could just use it as a secondary residence and have both sides of the duplex. It'd be a lot of house, but we could save that other side and use it ourselves, okay, for family, visitors, etc. We could also potentially convert it to an Airbnb, a short-term rental. And so we would have 7 months left that it could be utilized as a short-term rental. And as long as the average number of days is like less than 7 days, I'm simplifying this, but you should be able to put this onto Schedule C. And that becomes really big, because if I save this $20,000 deduction for January, and then in 2021, I get another property tax bill of $20,000, that would be $40,000 of property tax that would all get paid in 1 calendar year. If I can get enough short-term rentals next year to get the median or the average number of days down below 7, and I can justify this as a short-term rental, then this goes onto Schedule C instead of Schedule E. And then Shazam, all of those losses become real losses that I can offset our W-2 income, because those Schedule C losses are not privy to the passive activity loss limitations, but it's not a passive loss. Short-term rentals are active businesses. As long as you keep the number of days under 7 and some other things. Okay, and I'm not a CPA here, but this is reasonably legitimate, and there's data to support this. Tax law cases, okay? So by saving that $20,000 expense from 2020, assuming I'm not gonna pay taxes on this property anyway, and waiting till 2021, then I potentially, if in 2021 I'm able to get the property onto Schedule C, then that loss becomes an active loss, $20,000 of tax savings, tax deduction that gets applied onto our tax return and saves us $7,000 in tax next year. Okay, it defers it, but it still will have to potentially be recaptured later at some point, potentially. But that could be a huge savings. Just by deciding to pay for it in January versus deciding to pay for it in December of this year. Also, yeah, again, next year, they may, they could always repeal the property tax $10,000 limitations. And so I could, for example, if we moved into the house in June and then made it a primary residence, then we would have more property tax that would be personal use. It wouldn't be the full $40,000. It would have to be proportioned to the personal use portion. But if it's 7 months out of 12 months, and we have $20,000 twice paid, that's $40,000 times 7/12. So it's 280 over 12. That's like $25,000 of property tax that would be proportioned to our personal return. That would be very beneficial. Again, that's assuming if they were to get rid of that $10,000 cap. But if you pay that bill in 2020, you basically remove that possibility of having extra tax savings if I'm able to change the tax status of the property, moving into Schedule C, or just if the tax laws change. It's also more probable that tax rates are going to go up versus down. I mean, they may stay the same. They could stay the same for the next handful of years, but it's unlikely to go lower, right? So that's the one disadvantage if you move something later, is that if tax rates go down, then you've not only delayed getting that tax savings, but you're also getting a lower savings. I think the likelihood of that is very, very, very low with the current status of the election this year and the control of the White House as well as the House of Representatives. So just some things to think about when you're paying property tax if you have the choice between doing it in December or January. And also if you're thinking about converting a short-term rental or a long-term rental into a short-term rental. All right, that is it for today's episode 133. I am not an accountant. I am not a financial professional or your financial professional. Nothing here is legal, professional, accounting, any other advice, simply for my entertainment and hopefully yours. Until tomorrow for episode 134. Have a great night.